We're going to watch 3 videos today. First, why the dumbest investors win, and it's not what you think. The 3 real reasons why 95% of traders fail. And lastly, ending off on a serious note, why our financial system is breaking and nobody is ready for the bond market crack. So let's start off with why the dumbest investors win.
Dave's been trading for 2 years, which in Wall Street years is the equivalent of being a toddler who just discovered fire. His portfolio is up 13% year to date. He just hit it big on a crypto meme coin, and his confidence is at an all-time high. Dave's hobbies include watching The Wolf of Wall Street, telling girls at the bar about emerging biotech companies, and zinning. It's safe to say Dave has what it takes to become a full-time trader. So Dave does what any rational person would do. He calls his broker, lies about his net worth, and gets approved for options trading. Fast forward 3 months, and Dave is now leveraged to the max on out of the money Tesla calls. His strategy?
Leverage to the tits. That's what I like to say. Out of the money calls, by the way. Awesome. The strategy, buy high and sell higher. I bet it works.
Buy high, sell higher. His risk management? Prayer? His wife's concern. Why is $13,000 missing from our savings account? Fast forward 3 more months, and the Federal Reserve decides to hike rates. Dave's portfolio is now down 67%, and his wife's new favorite hobby is Googling how to divorce a man who calls himself a market wizard. This brings us to the question
Hey now. Hey now.
for the video today. Why do the dumbest investors win? The Dunning-Kruger effect is the financial market
I actually was thinking if he doesn't mention the Dunning-Kruger effect, I was going to mention it. So there we go.
version of Darwinism. It explains why dumb people think they're Warren Buffett, why smart people think they're dumb, and why Dave believes market manipulation is why his calls expired worthless. Since 2020, you could have invested in pretty much any stock and you would have made money. And if you were on the left side of the Dunning-Kruger curve, where Dave was, you would have significantly outperformed the S&P. Traditional value investors think investing is about fundamentals or fair valuations. But the investors who have outperformed over recent years buy companies at 650 times earnings, ride trends that make less sense than pineapple on pizza, and pump their bags to anyone with a pulse. In fact, I believe it was Warren Buffett that once said, "Why buy Apple?"
I love these fake Warren Buffett quotes. Mine is one in my slide deck is freak the F out, sell everything now. It's effing over. These fake quotes are so funny.
When you can buy Fartcoin. And if you zoom out even further, it gets more evident. We've been in the greatest bull market in history, 17 years, 715% returns. The S&P's basically been on a bender since 2009. So over the past 17 years, anything you've invested in would likely have generated a positive return. And because of this, investment strategies characterized by high beta and irrational approaches have outperformed and generated alpha, although it hasn't happened yet. Like all great benders, it must come to an end eventually. But when is this end coming? And how can you prepare for it? Well, there's 2 ways. The first, sit on cash like Buffett has.
No freaking way. Did he just say sit in cash and don't F up? Okay, that is hilarious. By the way, David, adding a little bit of context here, which I appreciate. MacArthur Wheeler is the guy who was the inspiration behind the Dunning-Kruger effect. He robbed a bank without a mask because he believed spreading lemon juice on his face made him invisible to cameras. I don't know how I came across this the other day, David, but I also heard that story. So he was convinced that because you can use lemon juice as like invisible ink or disappearing ink or something like that, that it would also apply to security cameras, right? So it would be invisible if you put lemon juice on your face. And when he was caught, because clearly, like he even looked at the camera and smiled real big, like you guys can't see me. And when they obviously caught him, they were like, "How did he?" Literally said something like, "How did you catch me? I had lemon juice on my face." And it was very much the peak of Mount Stupid right there, which is how the Dunning-Kruger effect came into place.
Has been doing. But that's boring, and you're not looking to compound at the risk-free rate. So that brings us to our second option. Continue to go all in, and then blame others when the markets inevitably reverse. You can blame Jerome Powell, Donald Trump, or even market makers. But you got to blame someone because taking losses on the chin isn't how investing works. All this brings us to the answer to the question of today's video. Why do the dumbest investors win? And the answer is simple, because retail investors love volatile, high beta stocks. Let's get a little more technical real quick.
Which, if you think about it, the Palantirs of the world, the SoFis of the world, the name some in the chat, the AMCs, the GameStops, they all want to ride that stage 2 wave, and they all feel like they're geniuses when they find it. But a lot of them have no idea where to exit, and if they did find it on the way up, that is awesome. That is great. I'm really happy for them. But a lot of them have no idea how to exit and keep any sort of profits, and they just ride it back down. Meme stonks, thank you very much, over and over and over, like hymns.
What is beta and why does it matter? Beta is a measure of the volatility of a stock when compared to the market as a whole. Here's a real example of beta in play. Let's say Amazon has a beta of 1.33. This is essentially saying Amazon is 33% more volatile than the overall market. So if the markets rise 2%, Amazon is expected to rise 2.66%. And then if the markets fall 2%, Amazon is expected to fall 2.66%. So why does this matter? Because when the market is up, a high beta portfolio, aka a retail investor portfolio, will outperform versus the market. And now you got Dave, who's looking to book a table at Nobu to celebrate his genius. But when the market is down, a high beta portfolio.
Okay, so I see this in the Discord, and it is real. The people saying the market is rigged, the market makers are out to get me, all those kind of excuses. They drive me crazy. And I've seen really smart people coming up with the market makers did this, they rug pulled me, etc., etc. It's just part of the game. Stocks move up, stocks move down. Does that mean that somebody is on the other end and they see Nate, and Nate's like, oh no, they saw my trade, they're coming after me? No, of course not. Mikey Mike is not out to get you. You will have wins, you will have losses. That doesn't mean that somebody's on the other side of the trade looking for Papalopagus and said, you know what, next time Papalopagus puts on a trade, it's going down.
Is feeling the effects of gravity. And now Dave is looking to see if Payway is hiring. In a bull market, Dave's high beta portfolio makes him the next George Soros. And in a bear market, Dave's high beta portfolio makes him the next trending post on Wall Street bets. So next time your friend brags about their 10-bagger meme coin, just remember, everyone's a genius in a bull market.
Yep, great channel. Go subscribe if you haven't already to the Casual Finance channel. Everyone is a genius in a bull market, yet nobody knows how to exit at the top. Exit when the moving averages are telling them to get out of the way. Let's take a look at Palantir real quick, right? You know, hang on, let me turn off the value zones real quick. We're not talking about value zones here. You know when the moving averages are telling you, when the math, in fact, let's back that up. You know when the math is telling you that things are not looking right? When your 10 is over the 20, price is over the 50, and you've got a big, beautiful uptrend like this, ride that dude as far as you can. But when the moving averages start crossing back over, that's a bad sign. That's a super bad sign. And this looks like a double top right here on Palantir with a lot of people ready to get out because they bought at the very, very top. A lot of stuck investors right here who created this order block are saying, please, Lord baby Jesus, get back to my level so I can get out of break even. I will never buy Palantir again. Let's watch this next one, I should say. 3 reasons why 95% of traders fail. See, these short videos are fun. We can get through a bunch of them.
95% of traders fail, and it's because of the same 3 mistakes.
I've always heard the stat that 90% of traders lose 90% of their accounts the first 90 days of trading. And if that happened to you, I want you to know something. It happened to me too. It happened to me too. It happened to me twice. I blew up my account. Twice. And now I've gone on to be significantly profitable in the markets. It hasn't happened to Brandon because he's an outlier, which is actually awesome to hear. I saw you put that in the chat yesterday. But this is real. And if it's happened to you, it's okay. You can still be successful, just like I've been successful in the markets. You can bounce back, but you have to learn the lessons, and you have to listen to mentors like myself who give away so much free alpha here on YouTube, and apply the lessons so that you don't repeat those mistakes that you made or that I made. So I'm excited to watch this video. Dr. J said it didn't happen to him because he found OVTLYR. Yeah.
New here, I'm Lance Brightstein, ex-Trillium top trader, mentor to 7- and 8-figure P&L per year traders, and I've made over $100 million in verified profits. Reason number one, they don't give themselves a long enough runway. Most people who get into trading have been sold a dream. Make a few grand a month trading options from your phone, quit your job and trade from the beach in 30 days. It's all total garbage. The reality, to even make a dime consistently in trading, it takes years. And that's if you're doing it the right way. With mentors.
So let's talk now. His claim of hundreds of millions of dollars is very dubious in my opinion. However, let's talk about time frames. Your first year of trading, if you can avoid blowing up, you're now in the top 10% of traders. Let's be realistic here. If in the first year of trading, you don't blow up your account, you are now in the top 10% of traders. By year 2, your goal is to not have a negative year. If you can scrape any sort of break even, that's all you need. Year 3, potentially making your first year of profits. If you can survive the first year of not blowing up, the second year of at least getting to break even, and your third year of at least getting to a slight, tiny, itty bitty baby bit of profits, you might be really successful in the markets. You may even be a market wizard at some point, because year 4 and year 5, if you have lasted that long, you have figured out all the wrong things to do, right? Thomas Edison spent 10,000 ways how to not make a light bulb. Think about that. He figured out 10,000 different ways how to not make a light bulb. And by doing so, think of all the lessons he learned, all the compounding growth that he had mentally to eventually lead to the right iteration to make a light bulb. That is exactly the same for you as a trader. You're going to put on 10,000 trades over the years, and over those periods, you're going to see what works and what doesn't work. But the smart investor, the one that actually maintains a profitable edge, will learn and apply and grow during that entire time.
Mentorship with structure, working full-time hours and treating it like a real craft. Think of it like basketball. When you shoot a three-pointer, chances are it might go in. But if you make one shot, you don't think you're the next Steph Curry. But when it comes to trading, people think after one or even after a few successful trades, they have it all figured out. If you're part-time, learning on your own, no guidance, no framework, you're looking at 4 to 5 years minimum before you even sniff profitability.
There you go. Exactly what I'm saying. Like literally, didn't I just say 4 years before you finally find profitability? Senior Wahoo, how about he killed it? By the way, everybody put in the chat, Wahoo, W-A-H-O-O. Everybody pay respects to Art in the chat. It's his 1 year anniversary of trading, and OVTLYR, not just me, has kept him from blowing up his account. Art/Senior Wahoo is now in the top 10% of traders. I know that sounds crazy, because all we did was keep him out of blowing his account, but that has now put him in the top echelon of traders, and he is on his way to making generational wealth, life-changing money. So congratulations, man. I'm so proud of you, Art.
If you don't know where to start to find guidance and frameworks, I highly recommend checking out my trading course. It's linked in the description. Far and away, the most common reason traders fail is due to unrealistic expectations. There are so many.
Ooh, that's a good one. This is actually a decent video. For a 3-minute long video, we can really talk about this. Unrealistic expectations. I think that's really important, right? And what he mentioned at the beginning is, right, it's like, hey, follow the strategy to make $10,000 a month. Bro, if I made $10,000 a month, I did something wrong. Let that sink in for a moment. If I made in my account $10,000 a month, I've done something hellaciously wrong. I don't think anybody needs to be shooting for a dollar amount. I think you need to be looking for percentage returns, and percentage returns that are far and away greater than anything that you could ever get by sticking your money in the markets. And it's hard for me to. I don't like to talk numbers, but I think it's really important to focus on processes, knowing where you're going to get in and where you're going to get out. Way more. And the money will take care of itself. The profits will automatically flow into your account if you have a profitable plan and if you follow that plan with consistency and discipline. That's what you got to do.
Many well-intentioned, smart, capable people who give up, not because they weren't talented, but because they didn't realize how long the road was. If you can only commit a few hours a week and you're treating trading as a hobby, that's totally fine. But if you're trying to make this your livelihood, you better be ready for thousands of hours of real work, because that's what it takes to stand a chance.
You got a dream, you got to protect it.
Reason number 2, they don't have a strong enough why. I talk about this all the time because it's the fuel that keeps you going.
That's interesting. That is an interesting point. Don't have a strong enough why. So let me know in the chat what you feel like your why is. Now, for me personally, it is the love of the game. Like I consider the stock market a video game like Mario or Assassin's Creed or name your favorite video game, Lego Star Wars or The Legend of Zelda, right? I consider it the greatest game in the world, obviously the most profitable game in the world. And for me, I remember specifically one day my son Colin, we're getting ready for school. I'm sitting on the couch while they're, doing their thing, getting ready. And he goes, "Dad, when are you going to stop trading?" And I was like, when I stop breathing? It's not because I have this overwhelming urge to swim in, my bank vault of gold coins like Scrooge McDuck. It's because I love playing the game. And so for me, it just comes natural, right? Doesn't mean I always win. And I want you to understand you're never going to always win. There is no 100% win rate. But for me, it's like a puzzle. It's like a chess game. Yeah. Justin says it's financial security for his family, right? Doc Father Ray says, "I'm old and I can't find a job." There you go. An enjoyment to do something that he can do whenever and wherever he wants. Yeah, it is the best game ever. SJ says, "Why? Why not better yourself in investing?" For sure, exactly. And you can see in the way that I speak and in my passion, and that's just me, right? You do you. That I love the game, and because of that, that's what drives me. Right? That's what drives me. I enjoy it so much just to play the game. TD says he fell in love with compounding in the market when he was in 7th grade, thanks to a substitute teacher that he never saw again. Antonio, we got to think bigger here. He wants to leave us an enormous fortune for his kids. Exactly. All right, let's keep going.
A lot of reasons people get into trading. Maybe they love challenges. Maybe they want to make money. Maybe they want to be their own boss or escape a job they hate. And honestly, there's no right or wrong reason. But this game is brutal. It never gets easy. Even at the top, I still have losing months. I still have days that make me want to quit. So whatever your reason is, it has to be strong enough to carry you through all of it. If your why isn't powerful, if you're not emotionally invested in pushing through the pain, you're going to quit. Everyone does eventually, unless they have something deep and real pulling them forward. The final reason number 3, they chase shortcuts instead of doing the hard work. This one's a killer. Most traders want the quick fix. The secret.
Yup. And listen, as a YouTuber, I see it. I see it in my analytics all the time, right? If I put out a video titled 3 best stocks in the market, it'll get 7 times as many views as maybe 10 times as many views as 3 reasons why 95% of investors fail. Because they want the shortcuts. They want someone to literally say, "Buy this stock." That's not what I preach. When people ask me what to do, I tell them, make your own plan. I mentioned it in the Discord just this morning. If the plan doesn't work for you, that's fine. You do you. I'm only sharing my plan because I know that I can trust myself to follow my plan. You're more than welcome to follow along and learn from my plan, but I don't think you're ever going to be confident in anyone else's plan, even mine, until you come up with what your plan is. Dr. J has a shortcut. I like that shortcut. I'm not biased or anything, but I like that shortcut, Dr. J.
indicator, the golden setup, the one perfect YouTube video that changes everything. But trading does not work like that. The only way to improve is to do the hard and sexy work. Studying thousands of charts, testing different strategies, tracking your stats, reviewing your bad trades.
This is sound advice right here. Every single bit of it is exactly what I preach all the time, and I love it so much.
Asking yourself the hard questions. What was I thinking emotionally here? Why did I ignore my stop? What pattern was I hoping for, and was it even there?
This is great. And this is, that graphic kind of got in the way, but this is what I tell you guys to do, right? Is A, journal your trades so that you can go back and review them when it's time to sit in cash and don't F up. Go back and review them, right? These are some of the things you need to look for. And then take your winning trades and your losing trades and put them in two different buckets here. And then look for commonalities between your winners and your losers, right? In your winners, did you follow your plan to the T? In your losers, did you jump the gun? Did you say, oh, you know what? I thought it was going to happen, but it didn't. Whoops-a-daisy, right? This is a big deal. This is how you become successful in the markets, is by observing what works and observing what doesn't, and then do more of what works and less of what doesn't. I know it sounds crazy, but when you can journal your trade, when you can look back and you can see these things, man, that makes your life so much easier. This should have been a bingo video, a 3-minute long video for like 17 bingos.
This kind of reflection, this kind of deep work, it's what separates real traders from hobbyists. One of the best ways to do this is by creating a daily report card to track your progress. And I'll show you how to do it in this video right over there. But most people would rather download some Reddit indicator than take an honest reflection of what the hard work they need to improve is. And that's exactly why they fail. So yeah, 95% of traders fail. But it's not because trading is impossible. It's because most people never even give themselves a fair shot. They quit too soon, they don't know why they're doing it, and they're not willing to grind through the hard work that.
And this is really important too, right? Because with the distribution of wins and losses is random. What do I mean by that? You could put on a series of 100 trades with a 50% win rate. Okay, 50% win rate. That doesn't mean one's a winner, one's a loser. One's a winner, one's a loser. One's a winner, one's a loser. That's still a 50% win rate. But also, so is win, 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 lose, lose, lose. That's a 50% win rate. Win, win, lose, lose. Win, win, lose, lose. Or even 10 losses in a row, followed by 3 winners, followed by 7 losses in a row, followed by 10 winners. That's still a 50% win rate, give or take. I might have messed that up a little bit, but you get the point. The distribution of when those wins and losses come is random. Okay? And because of that, you might have had 3 losses in a row, and you're like, F this noise. This outlier guy, he's so dumb. He doesn't know what he's talking about. And they quit too soon. And of course, a lot of people get in the markets because they see a random guy on the internet and they don't know what they're doing, but they're like, you know what? If he's doing it, I'm going to do it. I have seen so many YouTube comments where it's like, Chris, you lost me so much money, blah, blah, blah. And it's like, bro, I'm just following my plan. I don't know what the hell you're doing. You're on the other side of the screen, thousands of miles away from me. Why are you listening to anything that I say? That's on you, boo. That's why I'm always constantly telling you, follow your own plan. Because I'm not the one buying, click and buy and sell. That's you. And you've got to grind through the hard work of coming up with plans. Now, we had a cheat code over the summer, thanks to Scott, whose last day is tomorrow. Couldn't get a hold of Scott yesterday. I've yet to get a hold of Scott today. I don't know if he's on like all night benders and just waking up hungover and he's like, I can't do this today. I'm just joking. Scott's a good guy. And Scott's going back to uni after tomorrow. But my plan is to show you there's no more trust me bros. This is the data for this plan. Understand, this plan is backed with copious amounts of data, thousands and thousands and thousands of iterations to find the highest expectancy. But there's still a chance you're going to lose. There's every chance you're going to lose. Because we don't understand, or would not understand, we don't get to determine when those wins and losses come. The frequency of those, the distribution of those, that is completely random. And there's a lot of hard work that goes into coming up with the plan. And it's even harder to actually follow the plan when it's not working out. But that's the point of having the plan in the first place.
actually leads to mastery. If you can fix just those 3 things, your expectations, your why, and your work ethic, you'll be more informed than most that foolhardily attempt to tackle this profession. Armed with better information, that is how we can beat the odds and be the 5% of traders who succeed. And I'm sharing everything I've learned on this channel to make you a better trader. So subscribe and turn on notifications to
There you go. Subscribe and turn on notifications. CEO Hart says, I'm following you because I'm working and I'm learning so much. Outstanding. Well, now things are going to take a turn for the worst. A turn for the worst. Our financial system is breaking. Nobody's ready for the bond market crack. All right, let's go.
But nobody's ready for the bigger issue brewing in the background. Think about it. Does it seem like most people trust the government to bring down inflation and bring down their debt? Or does it seem like most people don't trust the government? Overwhelmingly, most people do not trust the government, which is why they're not purchasing bonds. On top of that, other countries are losing trust that the US government will ever pay
What a vibe shift.
them back, so they're not buying the bonds either. Even bigger than that, the central banks in the entire world are losing control of interest rates in general. This is very, very bad. Let me explain. Right now, we're seeing some very negative news about our job reports, unemployment, increasing credit card debt, and overall here in the US especially, the economy is not doing well and is trending downward. The Fed is traditionally the lifeboat here, and what they would do traditionally is that they would cut the rates so that eases what's happening here in the economy. When they do that, usually what happens is that it starts to spur on economical spending and the economy starts to rise again. However, right now, the bond market is actually showing that that system might be breaking and that things are about to flip to a place where they haven't been. Now, every 2 weeks in my exclusive group over on Patreon, we have a live Zoom where members ask questions and I go over my thoughts on the state of the market and what to watch for.
Every 2 weeks? Man, he should do it twice a day, every day on YouTube. I'm just saying. I don't know anybody who would commit that sort of time frame to helping people save time, make money, and start winning with less risk. I'm just saying. I don't know anybody who would go to that level of effort to make sure that you're successful. I have no idea who would do that for, 82 cents a day or something like that.
Recently, many were asking about this bond crisis and we had a robust conversation, so I thought I'd share some of that with you here on YouTube. Now, if you want to be in on the inner circle and get information as soon as it happens, because I do share things there first, click
I'm gonna fast forward.
the link down. I know that you probably don't love bonds as an investment, and neither do I. But at the end of the day, bonds are actually the things that actually run the world, because at the end of the day, they're the things that actually set the interest rates for things like loans of all sizes, mortgages, and even the value of the dollar. Right now, all over the world, long-term bonds are rising at rates that are absolutely crazy. Normally, when central banks cut rates, the bond market usually follows, and those rates go down too, but it's looking more and more like central banks are actually losing control, and if that happens, we could be in for something worse than a recession. In this video, I'm going to give you the quick highlights on what's happening in the bond market all over the world, but specifically here in the United States, and why that matters so much to you as an investor. If you understand this, it's going to make you a much better investor, especially long term, which will definitely make you much more rich. I'm also going to explain a couple of ideas and things for you to invest in to prepare for this, and exactly how I'm investing with this new information. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So just as a reminder, and maybe for those of you that don't know, if one says bond yield or interest rate on the bond, they're basically saying the exact same thing. If bond prices go up, the bond yield will go down. If bond prices go down, the yield will go up. Well, our bond yield in the US has been rising like crazy since 2020, from 1% to over 4% in the fastest pace ever. So like I said earlier, when things usually go haywire in the financial system and yields are quite high, the central bank will decrease its Fed rate, and that brings down interest rates all around. Things like high yield savings account, money market, short-term bonds, things of that nature. The problem is that right now we're seeing a little bit of the opposite. Fed rates looks to be dropping lower in the near future, while the bond yields look to be increasing. And this is the first signal that our monetary system is about to be flipped upside down. Here's a couple of quick points of what's going on in today's bonds. Number one, as we know, there's a weakened demand for the bonds, just in general. August's US Treasury 30-year bond auction lacked force, marking the year's weakest demand with a bid-to-cover ratio of just 2.27, low participation from end users. Basically, nobody wants to buy our bonds right now. Number two is this expectation of a steepening yield curve. According to a recent poll of bond strategists, the short end of the curve, the 2-year notes, is set to fall as markets anticipate Fed rate cuts. But the 10-year yield is expected to climb, reaching 4.2% in 3 to 6 months. This moves the 2 to 10-year spread towards its widest level since early 2022. Number three, and this is the big one, is the warning of a bond crack. JP Morgan CEO Jamie Dimon called attention to mounting risks, highlighting the combination of rising debt, geopolitical tensions, and regulatory constraints that are straining bond liquidity. He warned of a potential bond market crack where confidence falters, yields surge, and liquidity dries up. If the bond market actually does crack, this is going to ripple through all financial markets. Here's what it could look like. So when I say bond crack, what I mean is that investors are going to stop buying bonds, especially long-term treasuries. Yields are going to surge because the government must offer higher interest rates to attract buyers. And liquidity is going to dry up as it becomes harder to buy and sell bonds without huge price swings. So these are the main consequences, and then I'm going to tell you exactly how to prepare for this or what to invest in. Number one, government financing costs are going to explode. The US Treasuries are the world's risk-free benchmark. If yields spike, Washington's borrowing costs on trillions in debt rise sharply.
This reminds me of, man, I don't remember specifically of what it reminds me of, but there's, you know, when everybody's saying the sky is falling, that's when everything just like turns around, right? Hang on. It reminds me of the market cycle. Hold tight. And go to that slide real quick. It reminds me of this. Give me a moment here to get over to it. It reminds me of, wait for it. It reminds me of, what's that slide? Reminds me of this, where you've got so many people screaming, oh, panic, panic, freak out. Oh, everything's going to hell in a handbasket. Oh, everything is awful. And then one person like starts saying, oh, you know what? Maybe it's not so bad, right? Goodbye, bye. It's the irrational exuberance. That's what this reminds me of. Irrational exuberance goes both ways, by the way. Irrational fear, irrational greed. That's what we measure here at OVTLYR. And it feels very much like we've seen more and more people screaming this side over here. It's just what it sounds like to me. And it feels like this is one of those fear-mongering videos.
That's going to worsen the deficit. Number two is a stock market turmoil. Higher yields compete directly with stocks. If you can earn 6 to 7% risk-free, investors are going to rotate out of equities, specifically growth stocks. Now that one is a huge one. As of right now, a lot of huge investors, think Warren Buffett, have a bunch of money off to the side because they're getting a guaranteed 4.5% just sitting it there, and it's risk-free. If they can get something like 6 or 7% totally risk-free.
Did he just do the meme? Did he do the meme on purpose? 6, 7. Okay. If you have kids, you know. Dude, he totally did that on purpose. There's no way he didn't do that on purpose.
Why would anybody be investing in the stock market? And if nobody's investing in the stock market, or they're pulling money out to put it into this risk-free option, that stock market's going to plummet big time. Number three, mortgage and loan rates are going to jump. A spike could push mortgage rates back above 8 to 9%, freezing housing activity. Businesses would absolutely slash investment at that point. Number four would be corporate and global debt stress. Corporations that rely on cheap debt would see refinancing costs soar, raising the risk of default. Emerging markets, which many borrow in dollars, could face currency crisis as dollar-denominated debt becomes unmanageable. Number five is a financial system instability, which is huge. Treasuries are the collateral backbone of global finance. Sharp drop in bond prices could freeze liquidity, trigger margin calls, and force fire sales. Similar to 2008, but centered around bonds. So hopefully you're starting to understand the gravity of the situation here. Let's move on to what one can invest in and how you can prepare. Here are 5 things to consider for your portfolio, and then after that, I'm going to explain exactly how I'm investing specifically. Number 1 would be gold and precious metals, basically a safe.
That's what I'm feeling right now, Phil. By the way, who nailed it? I think it was Skinny Buff Guy. Gold recommendation incoming. Here we go. His number one top pick, gold and precious metals. There it is.
Haven. A bond crack equals a fear of fiat instability, so that's going to bring a demand for hard assets. Gold and silver to a lesser degree often rallies when investors lose confidence in paper assets like bonds or currencies, which go check the gold market right now.
Yeah, gold has been on fire /GC. Gold futures. Dude, literally the last time, go. Why aren't you going? What do you mean invalid symbol? You just told me it's right there. Hold on. /GC. Gold futures. Do I need to like expand? Oh, okay. Go. Why? Why are you fighting me on this? I go to GLD. That's fine. But yeah, GLD is a gold ETF, and you can see that it broke out of this range. Boom. Let's go to SLV. Silver ETF. Boom. Moving up higher and higher and higher.
Look how it's been doing over this last year to date. A lot of people have already started this revolution because a lot of people and institutions are definitely already on this track. Physical gold bullion or even solid ETFs like GLD or GLDM are great options. Gold miners like GDX and individual producers can offer leveraged upside, though they're more volatile than bullion itself. I also specifically add Bitcoin in here. I believe it's digital gold and has not only held its value, but also has sharply increased in value, and I think it will only increase more due to all this craziness. Number 2 to consider would be energy along with commodities. Energy like oil, natural gas.
Okay. I doubt that what is crude? Is it CL? Crude futures, yeah. Can you go? I have no idea why this is fighting me like this. Hang on. Invalid symbol. Doesn't exist. I know it exists. You just showed me it exists. /CL. 1? No? Exclamation point? No, I don't know why. This is giving me all kinds of issues today. Let's go to USO. That is a gold ETF, or not gold, oil ETF. This has been trading sideways for how long? Since August of last year? No, let's go back further. March of 2022. Basically sideways, a little up, a little down since March of 2022. Because it's the futures market. It's not a ETF. It's not stock. That the futures markets start with a slash, right? You can see /CL, and it shows me right there crude oil futures, and I can go into any one of them. And if I click it, it's like it doesn't exist. What in the wide world of sports is happening? I don't know. Let's keep going.
Gas and broad commodities often benefit because they're real assets, not tied to financial system promises. If inflation expectations spike with bond yields, commodity prices tend to rise as investors hedge against currency debasement. ETFs like XLE for energy, DBC for commodities, or direct commodity exposure like in.
You guys are saying don't type the slash and it should work. Let's try it. CL. That's Colgate Palmolive. Crude oil futures. Oh, there it is. Okay. Sorry. There's still things I'm learning about TradingView. Okay. Thank you for that, by the way. Oil going down and down and down and down. Okay. So does that mean if I go GC, it'll give me gold? No. Gold futures. I have to click it. Can't just rip it. There we go. Thank you guys. All right. I learned something. It was because I'm such a slash fan. Exactly. And let's go to was it SL? I think is silver. Maybe it's not SL. I forget what silver's code is. What is silver's code in the chat? GC1 is gold. Oh, it's probably trying to divide. I see what you're saying. It's too smart for me. All right. I see a little division, multiplication, things like that. What's the silver future again? I can't remember. Silver futures. Silver futures. That's definitely not right. It says 135,000. Anyway, let's keep going.
investing directly in gold or silver or copper or something of that nature. Number 3 is cash and ultra short-term treasuries. The paradox is that
cash and ultra short-term treasuries. You mean SGov? Cash and ultra short-term treasuries is exactly what SGov is. How about that? Oh, it's SI. SI. Okay, thank you. SI. There it is, silver futures. And like I said, you can't rip it. You got to click it. There you go. There's silver futures.
long-term treasuries may collapse, but cash-like instruments and very short bills, 1 to 3 months, could benefit. They roll over quickly, so investors see them as safer compared to locking in 10 to 30 years at uncertain rates. Money market funds and treasury-only ETFs like SGOV,
Oh shit, SGov right there. Let's go.
BIL could draw inflows. Number 4 is so important, and it's going to sound very similar to something that I talk about all the time on this channel, but this would be strong balance sheet companies or strong value style companies and ETFs. Firms with low debt, strong cash flow, and pricing power become more valuable when debt is expensive. Examples would be consumer staples like Procter & Gamble or
Okay. What are the 2 sectors? Tell me in the chat. Looking for audience feedback here. What are the 2 sectors that I tell you guys that if they're doing well, that is bad for the market? What are those 2 sectors? It's right there on the screen. Here. This is an open book test. Let me circle the answers for you. There we go. I know, right? I know. It's almost like I know what I'm talking about. Isn't that funny? Isn't that funny?
Coca-Cola, healthcare like Johnson & Johnson, possibly United Health down the road, and utilities with regulated pricing. Dividend or value ETFs like SCHD and quality factor ETFs like QUAL might hold up better. We all know what SCHD is, as I talk about it often on this channel, and it's one of my biggest holdings. But this ETF, QUAL, is the iShares MSCI USA Quality Factor ETF, and it has exposure to high-quality US stocks. And they access profitable US companies that have low leverage and demonstrate consistent earnings over time. So many different reports and so much that's going on throughout the world geopolitically and just in general should have you start to think about maybe not having as much risk in that portfolio, not having all of your portfolio in very risky growth, technology only type companies. I'm hoping that you have that balance with some SCHD or Berkshire Hathaway or something with a lower volatility rate. Number 5, though, it's all about just buying the dip on solid ETFs.
That's a tough one for me. That's a tough one for me. If your plan involves it, yes. If not, that is a recipe for disaster. Let's talk about that yesterday, because we bought the dip on Qs yesterday, right? We bought the dip on QQQ yesterday because it fell into our value zone. Our value zone is between the 20 EMA and 2 ATRs above that point. Now it's down this morning, right? But that doesn't mean that every down day is going to result in, the market crashing down. So that's why it's so important to have your own plan, right? I've already seen posts in the Discord. Trust me, I've already seen posts in the Discord about how this isn't going up immediately vertically. Okay. I need you guys to understand this. Plan ETF is not meant to be an offensive plan. Plan ETF is a place to get additional yield instead of SGov in the meantime until plans A or M set up. Also, another reason why we're buying shares versus buying the options, right? So I've already seen it in the Discord today, and I'm really surprised by the reception of Plan ETF. It is meant to be a conservative plan, but I feel like so many people are looking at it like it's the it's the worst thing. Maybe not the worst thing, but they have so much anxiety and hesitation, it seems like, but yet they'll buy long calls all day. I'm missing something here. I'm missing something here. So anyway, let's get back to it.
If things get as bad as what I'm talking about here in this scenario, if bond prices really do go nuts, then the stock market will surely crash. One thing is for certain though, very solid broad style ETFs are going to come back eventually. And not just come back, they'll go to all-time highs just like they did in the dot-com bubble and just like they did in the financial crisis and during COVID. This is just going to be another one of those crashes, so you might be able to find very solid ETFs, things that track like the S&P 500, total US stock market, Dow Jones, NASDAQ 100 even. You'll be able to get those at a solid price, and at that point, it's going to be a good idea to be buying the dip. So what am I doing to
But please hear me when I say this. If you buy the dip and you have the moving averages crossed down, if you have the trend template crossed down, get out of the dip. It's over. Okay? You don't know how much further it's going to go down. You do not know. So don't be buying the dip on the way down. Wait and buy it as it's crashing up. Now, please understand what I'm saying here. Getting this yesterday, it was buying a slight pullback into the value zone, which was exactly 100% following my plan. Okay? I didn't deviate from my plan whatsoever. That's why we take the time to work on and create these plans. But I'm telling you right now, if the 10 and 20 cross, that is one of my exit signals. In fact, let's go over those exit signals real quick. Right? If one of these happens in plan ETF, that's okay. It is totally okay. It just says it's time to get out. Right? A sell signal, a 10-20 bearish cross, or an order block is hit. Also, I want to talk about something I posted in Discord this morning. I was walking around the neighborhood and I wanted to talk about, hang on, let me do from Owen, me. There we go. Let's see, I forget what it was. Here we go. We'll leave off on this. Remember, we as outliers need to treat our accounts like we are fund managers, right? We are not, in fact, going back to the very beginning of these videos we've watched today, we are not normal. What we're doing is not normal. What we are doing is in the top 10% of traders in history, okay? What we do is not normal. Freaking out, getting emotional, not following a plan is exactly how 90% of traders blow up their account, okay? This is not normal what we do. And we need to treat our accounts as if we're fund managers. Like I've told you this many times. Go over to your LinkedIn, change your current role from whatever you're doing now. And you know what? Do it side by side. Don't change what you're doing now. Add in plumber, add in real estate executive, add in whatever. And then beside that, concurrently put fund manager. As a fund manager, I know it sounds crazy. This is going to blow your mind and it's going to hurt a lot of people's feelings. We're not concerned about winning or losing. Let me repeat that. I know this is going to hurt a lot of people's feelings. On any one individual trade, we're not concerned about winning or losing. That is going to blow people's minds. People are going to be leaving ugly comments. I get it. We are not concerned about winning or losing on any one individual trade. A fund manager is concerned about making sure he has a profitable plan, of which plan ETF is one of our most profitable plans, and then executing that plan flawlessly. This is what a fund manager does. This is what Warren Buffett is doing. This is what Ray Dalio is doing. This is what Paul Tudor Jones is doing. This is what Mark Minervini is doing. This is what the successful fund managers are doing. And you get to do it too. A fund manager is not concerned about winning or losing on any one individual trade. He/she is concerned about making sure that he/she has a profitable plan and executing that plan flawlessly. And when you execute that plan flawlessly, profits are inevitable. And they take care of themselves. Let's make a correlation here, right? Let's say your plan is to weigh 500 pounds. All right. If your plan is to weigh 500 pounds, put in the chat. Put in the chat. How would you get to 500 pounds? First, I would go order 3 Costco pizzas a day. Those things are huge. And then I would make sure to binge watch Netflix all day long. And then I would make sure to get multiple 2 liters of not Diet Coke, but full calorie Coke. And I guarantee you, within 1 day, I'm definitely up on pounds. Within a week, I'm definitely up on pounds. Within a month, I'm for sure up on pounds. Within a year, I might hit my 500-pound goal. We know this. This is facts. It is an inevitability. You will have the outcome. It will take care of itself. It is an inevitability. Ready? Let's transition. What if you wanted to look like Arnold Schwarzenegger? Okay. First, you'd have to put away all those pizzas. You'd have to start buying Diet Coke or Coke Zero instead of full calorie Coke. You'd have to go to the gym. You'd have to take special supplements. But you could achieve a bodybuilder physique outcome, and it would be inevitable. The outcome would take care of itself. Between these two things, what are you doing? You're following that plan and you're executing that plan flawlessly. Now, going from health and lifestyle to financial success, the correlation is perfect. It is a perfect 1-for-1 correlation. Follow the plan, execute the plan, the profits are inevitable and take care of themselves. Did we get that? Type in number 1 in the chat if this makes sense to you. Type in number 2 in the chat if it's not clicking just yet. So I hear what you're saying. Oh, the plan. Yeah. Follow the plan. Whatever your plan is. Don't follow my plan. I'm just ramming down the internet. I don't know anything. But the profits, and this is what I learned from Mark Minervini. This is what I learned from Steve Burns. This is what I learned from the market wizards. I've worked with 5 market wizards, the best traders in the world, and they would tell you exactly this same thing. Create a plan, follow the plan. The profits are inevitable, and they take care of themselves. And you will have losers, and you will have winners. But we're not concerned on any one individual trade. It's like walking into a casino and the casino being scared to death that you might walk out with a profit. You really think that's going to happen? No, of course not. Because they know that they're going to lose on some of these bets. They know that they're going to win on others. And they're going to execute that plan flawlessly. And the casino's profits are inevitable, and they take care of themselves. Can we name the top outlier traders after Lord of the Rings wizards? I love it. Michael Ross, the boss, says plan is one thing, but the emotional part of following a plan is the hardest part. No one wants to lose, but it's going to happen. Well said. That's why he's the boss. IC says, over time, I stopped stressing about losses. Yesterday, I was really upset because I closed the trade without a valid exit signal. Looked at the wrong line in my journal and closed it by mistake. Now, I'm really glad that you mentioned that, because that trading errors happen. I have done plenty of trading errors. I've done them live. And unfortunately it happens, right? But we can learn from it. We can improve upon it, and we can set ourselves up in a way where it doesn't happen again. We got the data. We just need to work on the psychology. That's where I come in. Right? That's how I come in as your mentor. And I do this twice a day, every day. And the invitation only live streams only cost you 82 cents a day. So listen, I want you to be successful. That is my goal. My goal is to make Masters of the Universe money. And if I can do it, there's a great chance you could do something pretty great as well. I can't guarantee profit. I wish I could say, if I can do it, you can do it. I can't say that. But I can say, if I can do it, and you follow a plan with high probabilities, high expectancies, maybe something awesome can happen to you as well. So that's going to wrap it today. Listen, if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos. And have a fantastic day. We'll talk soon.